Okay, okay, perfect. The recording has started. And hello, everyone. Today we are with Paul McClone, the CEO of Sing Machines. We've been covering the company for a while, and we are here to ask him some questions. Q3 was spectacular. It really showed that the GSR ramp up is really here. It's now I think 1.3 million in automotive volumes. The aftermarket was still a little bit weak, but we're seeing real progress there. The company is transitioning towards cash flow positive. The market in front of us is quite big. Why don't you make us a quick intro into what those Q3 results mean for the company and what this means for automotive going forward?
Yeah, look, Hugo, first, thanks for having me. It's a real pleasure to chat with you today. Yeah, Q3 was really the important month for us. We've been expecting this big leap in royalties as we transition closer to the GSR deadline of July 26, so just literally weeks away. So in the prior quarter, December, our technology was put into 580,000 vehicles, and in this quarter just gone 1.28 million vehicles. So call it just about 1.3 million. So 122% increase, more than a 250% increase on the same period last year. And this gives us a great deal of confidence that over the next couple of quarters, that we will achieve kind of the range that we've been talking to the market about, which is quarterly volumes in excess of 2 million as we come out of the quarter following July. So GSR well and truly underway. I think our position in Europe is really strong based on this set of numbers. I think it's important for me to say that we've seen an increase across the entirety of our customer portfolio. So it isn't just one customer, leading the volume charge. It's consistent across all of them. So that's the first thing. And then, obviously, automotive royalties are, once earned, essentially a drop down straight into profit and cash. So royalty flow and royalty growth rate is also the major contributor to cash, and so that this is really pleasing that it's come now, and we expect it to continue over coming quarters.
Sure. Another really important metric I've noticed is the average revenue you generate per unit. You mentioned that it was on the higher end of your range, what you were expecting. Is that an internal range, or it was on the higher range of what we already have been seeing? You don't publish that number, but from it's quite easy to find it just doing a division. It's around 8.5 and 9.5. It's towards the higher end of that number. Are you seeing that?
It's probably around the midpoint between those two numbers. But I think that what drives ASP is essentially the mix. So our customers generally have choice in terms of the number of features that they build into a given model. So for the lower value models, they might be just a basic set of features just to cover GSR. For the higher value models, what we call the business pack, more features. And what we've seen is kind of an overweight position on greater features. And I did expect, as we move towards GSR with more mass market or lower value vehicles, that would average down a bit, but we haven't seen it in this quarter. So it's going to be interesting to see what these OEMs decide to do with the feature packages, and ultimately what proportion is the higher order features versus the absolute minimum features. So we won't know that until we sort of have the first quarter next year. But once we hit that point, I think from there it should be relatively easy to forecast. But right now, higher than expectation.
Okay, understand that, because as far as I understand, I've been looking at social media, at press reports. The accuracy, it's a big pain point for auto manufacturers, OEMs. You know, a 20K car, they are getting complaints due to an $8 piece of software. And, that might indicate that they will look into higher value features, more precision in order to avoid that customer complaints.
Well, I think there's a couple of ways to respond to that. I think many of the vehicles that are having poor performance, i.e., high levels of false positive and therefore high levels of customer annoyance, they're probably not $8 or $9 software bundles. They're probably from someone else, and I dare say they'll be half or less. I
Yeah.
mean, if you look at the publicly available information on ASP, it would appear at this point in time that we're considerably higher. But I do think after GSR, there will be a reset, and that reset will be driven by customer experience and performance. So I think for those that can perform at a higher level, deliver a much stronger true positive outcome and a much lower false positive outcome, and I would classify ourselves as a leader there. I think that might be the next wave that dictates who wins an RFQ rather than 95% of the focus being on price.
Yeah, yeah, I understand that. And I think this is a good moment to chat about something we've talked extensively before. That's the difference between what Sig Machine does in terms of the product and the engineering versus the main competitor. Many investors probably don't understand why you have such a high cost base and also why your ASP is higher. Like, could you explain a little bit what's the difference, what you make different than your competitors?
Well, rather than explain what others do, I'll explain what we do, and what we do is a little bit different. So first of all, we take a systems approach to design, and that starts with the way we deploy our human factor science in designing algorithms and software that can be delivered in an environment with the user in mind. So that's the first principle of design that we look at. From there, as we're developing our software and we consider the system that it's going into, we deploy a lot of know-how into the optical path design, certainly often acceleration, the kind of silicon that's used, but essentially consider the system, the ECU or the operating environment, and all of the different aspects in that bill of materials. We offer a specification, if you will, that considers the software operating within the system. So it's more about system design and software design. And so what we're able to do with our customers quite readily is show them the trade-off between price and performance across the whole system, not just in the software. So we put a lot of effort into that, and it is an overhead for us. But our experience is, by working in that way, well, 100% of the programs that we've been involved in have hit the start of production. And so I would argue that approach minimizes implementation risk. It also minimizes what is the very normal level of friction that occurs just prior to start of production, because a lot of those aspects of design that are anchored in the human experience have been sorted out right from the beginning. You're not rushing to fix sort of user identified problems at the very end of a program. That's an extremely difficult thing to do. So that's what we call our systems approach. And it includes not just developing the software and handing it over to a tier one customer or an OEM customer. It includes being heavily involved in design, and in particular, the design of the optical path. And, a lot of the sensor companies in this space seek advice from us on, how far they can push technically, what the price performance trade-off is vis-a-vis software. And this is an area that we specialize in. And I would put those questions that you put to me down fundamentally to that approach.
I understand. Basically, it's more a hands-on approach, like you do the software and also the integration.
Well, not so much the integration, it's the design. So we design
okay.
not just the software, but the key aspects of the camera
Okay.
and the optical path, because those things are inextricably linked when you start talking about performance.
Yeah, that's definitely a good software will work even better with a good camera. Yeah,
Yeah,
and the opposite is even more true.
exactly.
Then something that it concerns a lot of people is post 2028. We've seen lots of contracts, not only from you but from the other players. Most of them are starting 2026 and reach 28, 29. What's happening post that? What's happening post 28, 29? Why are we not seeing those follow-up contracts? What's the reason behind that?
I think there are quite a few reasons, but if you look at what's going on in the automotive industry, the amount of change, the implications for brought about by, say, Chinese exports, Chinese technology, autonomy, EVs, software-defined vehicles, tariffs, and if you put all of that in a bundle, you see that the life of an OEM is extremely complex, challenging, and that there are really big risks, both technical and financial. So my view is that in the lead up to GSR, for the last year, there hasn't been any, all of the programs relevant to GSR have been awarded already, obviously. And so what those OEMs will do is, I think they'll just ride this out a little longer. And that creates a real benefit to the incumbent. So the first thing is not to be worried about the fact that there haven't been recent RFQs. I think that is a net benefit because those programs will continue. Logically, they're not going to stop. There is a build-up in the RFQ pipeline right now, though, and I'm expecting over coming months that we will see a number of awards, probably evenly split between Europe and Japan, I would say. What we're seeing in those awards is smaller initial values than what we saw at the beginning of the sort of GSR process 3 years ago. But I think getting back to the point about incumbency, I don't really think it matters anymore. If you can win an award with an OEM, I think that gives you a very real opportunity to continue to expand through either change requests or just natural volumetric growth. So we would see the fact that there hasn't been in the last year RFQs highly beneficial to the incumbent position, and that would relate to our competitors as well as us for the companies that they're in.
Okay, I understand that for Europe. There's also on the US, there's been some news flow regarding the possible ramp up of similar regulation in the US. I think in that area is more uncertain when it will hit the regulation, and there's been also on the public page, like a lot of people are complaining about how invasive can be having a camera in your car. How are you seeing the environment there in the US, and how are you framing the opportunity?
Well, yes, there is a time frame for regulation, and we're thinking it's sort of 28, 29. There was a big movement in the US around impairment, and so we have a strategy on introducing impairment capability. There's a lot of noise around lockout technologies, and I would be highly skeptical as that those kind of technologies will be forced into vehicles through regulators, despite the noise in the market at the minute. But the real driver of interior monitoring today in the US and in other markets that don't have the same kind of regulation is twofold. One's safety, and the second is led through technology. So if you have let's say, a driving system that is level 2 plus, 2.5, where you have the ability to have hands-off wheel for, a few seconds, all of those vehicles have a driver monitoring system. So the driver, that's probably not the right term in this case, the thing that's really causing the uptake of driver and occupant monitoring systems in the US is the take-up rate of level 2.5 systems, or 2 plus systems. Now, what's important to realise, and that's, whilst the regulations are being developed. So we will see that accelerate, I'm almost certain. So I think quite important there is that those level 2 plus systems, one of the fastest areas of development in vehicles today is they're being pushed down into the cheaper models. So ADAS, hands-off, I think we'll see a much faster take rate over the next, 3 to 5 years of those technologies in base level vehicles than in the prior 5 years. So that will augment the pathway that we're seeing for regulation, but regulation will come.
True. I understand. And what's your go-to market, we could say, on the US? I assume on the players you are collaborating on here, and they also sell in the US, like you go with them. And with for example, General Motors, how it's your approach to gain that type of customers, and who are you competing in the US compared to Europe? Is the same players? Is there someone else?
Yeah, it's the same. Look, our customers are tier ones, right? So what we try to do is collaborate as closely as possible from a technical point of view with our tier one customers. And in the US, that's, primarily Magna. I think everybody is aware. Although we deal with, a handful of tier ones around the world. So we don't really want to compete with our own customers. So we tend not to try and sell programs directly to OEMs. I think there's a lot of onerous conditions that come with that also. So that's an important part of that equation. But I've never thought it's good business to compete with your customer.
Yeah.
So we really take the lead from our tier one customers in terms of which OEMs we're pursuing. But for many OEMs, not all of them for sure, we have some great relationships and some less great relationships. But for those where we have strong relationships, we do interact with them on a technical basis quite often. So we talk about roadmap, we talk about the possibilities of where the technology can go. We talk about the use case, all of these things. And we talk about the user experience. These are all things that the OEM's deeply interested in. But at the end of the day, for us, there needs to be a program launched by an OEM that's won by a tier one, which is our customer, and that's the path that we choose.
Okay, understand that. Then a little bit, a big driver in terms both of the US and Europe. We already mentioned it slightly before. Accuracy. I think that's a big pain point everyone is seeing right now. How is seeing machines approaching that? It's a problem for them. It's an opportunity.
Well, for us, accuracy, high true positive, low false positive, that is a design fundamental. So we don't set out to design software that can merely meet a current set of performance criteria. We set out to design software that can deliver the highest performance outcome. And if we're talking about accuracy of gaze or whatever it is, the highest performance outcome from the get-go. Now, why this is really important, and I think this will be the case for a lot of those products that have been exported into the rest of the world from China, for example. And Chinese regulators have jumped on this really quickly. False positive alerts and annoyance are bad for business. They're bad for business because it hurts the brand, but it's also bad for safety because people don't pay attention if they're just being annoyed all the time. So it's a real problem. So since our inception, we've been designing products with the operator, the driver experience at the forefront of design principle. And I think that's why our products score highly in that regard.
And how should we think about the technical mode? We could say on seeing machines, why are you able to achieve higher performance than practically everyone in the market? It's a data advantage.
Well, it's I think as I mentioned, the design fundamental is the first step. How we design and what drives our design principles. Of course, data is extremely important. If you're developing algorithms to perform in a given environment, it's important to have data that is from the same environment. So we have a vast quantum of naturalistic driving data that we've derived from our aftermarket business over many, many, many years, billions and billions of kilometers. That is a fundamental contributor to how we put our software together and how we create our algorithms. Now, of course, we augment that naturalistic driving data with synthetic data, an area where we really excel. And these days, for some of the simpler features, AI-generated data. But those channels for data development complement, not replace, the quality of naturalistic driving data, particularly when you're talking about edge cases in extreme conditions. That's when it really makes a difference.
Yeah, definitely. And let's say a new player, because with many people think that with AI, many of the software solutions are in threat. How do you think that about seeing machines? Because I have quite a lot of engineering friends. They are not saying that software will go away, but they say that, I mean, let me explain. You had spent like hundreds of millions over the past 20 years developing this technical expertise, this technical mode. Now the price of developing that mode with AI has reduced. How do you think about that, and how are you implementing AI to get ahead of others?
So, like I mentioned in our systems approach to design and implementation, yes, we develop software, but we develop software that has to operate in a complex system, and that complex system has to consider the huge variation in the natural environment in which it's being used. And that system is often a subcomponent of a greater system with additional software where there is significant integration requirements in order to get to the unique use cases of each customer. So I don't see an environment where, someone with an AI model and a bunch of agentic support replaces what we do, because it's actually integrated in a system within a system, often within another system. So it's highly complex. But I think the real advantage in AI for firms like us is, how far we can improve our productivity, and in particular when it comes to the pace at which we can develop new features, the way in which we can automate the software development overhead, which is a big burden on delivering not just our kind of software, but any software that goes into either a regulated or a controlled environment, functional safety, ASPICE, all of these different systems requirements that are needed. That's in the past has been a manual overhead. and it's been kind of the limiting factor to implementation speed.
Yeah.
So I think a really big advantage for us, and we're well down this path, is exploring how we use AI to remove the non-value adding tasks from delivering software, whether that be faster R&D, faster proof of concept development, reducing the overhead in software delivery. All of those things are really positive. And my expectation is that over time, we're going to see quite a dramatic increase in sort of the revenue per employee, if you will,
Yeah.
as a measure of performance. And if it, my objective is to generate revenue faster, generate features and products faster that can accelerate our top line growth rate, and hopefully do that without increasing the overhead of the business.
True, definitely. Because I see that you're always talking about Sing Machines has lots of opportunities in front of it. It has aftermarket, automotive, like all of these areas need continuous improvement. But then you also have the part of Mitsubishi and other, we could say, side ventures. For a small company, don't you see it's quite hard to go into all of these adjacent verticals? How do you avoid getting lost on so many opportunities, so many optionality, and how you
Yeah, look,
prioritize?
it's a really important question, and certainly for the sort of product, our product suite as it exists today, we certainly have the capacity and the capability to continue to grow and augment the features and performance. That's for sure. But entering adjacent markets is also really important. And if we want to grow as an enterprise, um, I think leveraging the platform capability that we've built in auto, bearing in mind that's a market that requires very high performance at very low unit cost. So those fundamentals, uh, when we push those into new verticals, create, I think, tremendous profit opportunity for us. So I think the fortunate thing for Seeing Machines is that, yes, we have our largest shareholder, which is Mitsubishi Electric Mobility Company. And as we've said many times, we're working on a range of adjacent market opportunities with Mitsubishi. And if we were to go that alone, we'd have to seek out companies that are in verticals that are interesting. We'd have to convince them. We'd have to work on proofs of concept, probably at our cost, et cetera, et cetera, et cetera. So this relationship is extremely unique in that they have a wide array of other businesses that are not automotive. And we see the opportunity to deploy vision capability across those hard assets as a real potential step change in
Mm,
product capability and performance for them and their customers. And if we combine that with our ability to adopt AI to develop these features and functions more rapidly into the new verticals, but based on the platform that we've built to order, well, we see those two axes as being key contributors to success in new markets.
yeah.
Big shareholder, big positions in major markets that are relevant to us, adopting AI to leverage the platforms that we've created in auto to speed us up and getting into these new adjacencies.
Okay. Okay, understand. We will go later on deeper into Mitsubishi. Now I wanted to touch on aftermarket because it's the division is being a little bit harder to grow for the moment, because I wanted to point the frame that uh, Guardian 3 was released, we will say, year and a half ago, something like that. We had some problems in terms of the design and stuff like that that delayed it a little bit, and it created substantial cost to deliver this new product. And now we have this new product is much better. It's supposedly also much more profitable. Why are we seeing those problems in terms of sales? We are even below the Guardian 2 sales run rate. Why are we seeing that?
Look, I'll explain that. There are a whole range of conditions, and they're a little bit different between each market that we sell into. In the markets where we're kind of new, Europe and the US, all of the customers that we're targeting are in essence new customers, new to the brand, new to the technology. Those markets have been pretty well saturated by not competing products, but telematics offerings of one type or another. There's a natural instinct to want to compare. You know, if you've got a box side by side, it's a natural instinct to compare costs, you know, application performance, all of those things. And so those customers require proof, which is typically delivered through a trial. Many of those trials are extending longer than we'd thought. And then when you get close to the end, the kind of negotiation that you have to go through to actually win the deal these days, particularly for most of these are kind of what we would call enterprise customers.
Yeah.
Bigger contracts, more focus on the service level agreements, more focus on cybersecurity, more focus on GDPR. And so there's a level of complexity in the contracting of new large customers that is extending the timelines. So, you know, that's a true fact. Right now, today, for all those programs that we thought we were going to win in the last quarter and they've been extended, fuel prices are a major barrier. That's a right now issue. And of course, that will sort itself out in time. No one knows how long, but at some point. But that's a factor that's causing people to delay decisions. And that's another true fact. But I think fundamentally, our Guardian Gen 3 product was always designed to focus on a niche market, a large niche, but a niche nonetheless, heavy vehicles that transport either high-value goods, dangerous goods, or people. And if you look at the key customers we have around the world, that's what they look like. It's highly specialized. So we deliver a high-performing fatigue system that can identify the onset of fatigue, intervene in that risk. It's 24/7 connected to our Guardian Center, and it has a profound impact on safety. So for customers that are in the category that I've just mentioned, that also have a higher order understanding of safety and have typically, you know, well-developed either zero harm or safety programs in the organization, that's really the target audience. And they're sophisticated, they understand more, and the sale takes longer. So, look, there's no hiding the fact that we had a view that we'd be moving through the sales cycle faster. That hasn't happened. But we do have a growing pipeline. And I think when you have a growing pipeline, you can be confident that at some point you will get the conversion. We're of that view. I'm pretty confident that Q4 will be materially better than the quarter that we just posted, and certainly around the sort of core target numbers that we've spoken about several times before, and that's kind of our sort of base proposition for the quarter, and then that ought to lead us into better performance in Q1 of next year also.
Okay, I understand that. But in terms of the leads not converting, it's more a problem, or things getting delayed, or have you seen some customers that have cancelled the trials? They said that this is not for us.
Look, there have been some. It's a really small proportion. The problem that I've described is the problem that we have of an elongated decision-making process that includes trial and contract. And for the most part, for the majority, I'm highly confident that those issues will be resolved. I think the other thing to note is that we are moving into an environment where we are talking with numerous parties around a different type of business model. And without sort of being specific, we do have a range of plans that are designed to leverage our algorithms into other parties' products, and we see this as kind of our long-term future. So I think for us, our long-term future is, licensing software and combining that with service delivery that's
Yeah.
specific to the features that we license. And, this will be explored further and developed further over the course of this calendar year. But that is a really important sort of adjunct to our current hardware-related business in Guardian today.
Okay. Understand. Like basically a focus on pivoting away a little bit from that sales part and doing like you do in automotive, licensing a superior product to someone who has a distribution capacity.
Correct.
Okay. Okay, I understand that. Another thing I wanted to understand is on your cost base. Like you spend a lot on R&D. Like how do you see the cost of the businesses? What part is for, we could say, maintenance? What part is growth focused?
So, look, the way I describe this more broadly is the majority of the cost base is fixed, right? So we consider, service center cost for Guardian is fixed. So opportunity to scale in certain areas, particularly with the benefit of automation and the kind of AI capability that we've talked about in development, we are looking at pretty aggressively in the service or the cost to serve environment as well. Variable costs essentially associated with hardware sales, right? And obviously some project work, but they don't scale, obviously, but everything else scales. So in terms of our biggest sort of single line item, that's R&D, sort of followed by operations, and streamlining processes and using AI as described is a really important part of that going forward. But there is a very real opportunity for operating leverage on this largely fixed cost base. And I think that we've brought the R&D costs down quite a bit over the past year or
Yeah.
so, and we expect it to be maintained at the current level for some time. So as royalties grow, we don't see any growth in the variable cost base. So that has massive operating leverage. And certainly over the next couple of years, we'll see R&D contract as a percentage of revenue because of that. And I expect that we'll see the same for our Guardian monitoring services as well. So that's how I would see that.
Okay. Okay, I understand that. Then a little touch on aviation. That's been, stopped for a while. I know it seems like you are looking into restarting the collaboration with Collins. How are you thinking about that segment?
Yeah, it's really, this is entirely linked to Collins. So we haven't kind of stopped working with Collins. It's more that our partner, our exclusive partner, has focused on other areas of opportunity. Like defence, for example, is a much
Yeah.
more important area to them recently. But we are certainly working closely with them to kind of reset the plans. And again, over the course of this year, we'll see that. There are other programs that we have in place where we will see some performance improvement. We'll see some revenue generated again over the course of this calendar year. But it is, at this point, a smaller part of our business. We're still in it. It's very low touch. And when Collins sort of restarts its engines here, we will see a benefit.
Okay. Okay, understand that. Then the last segment, big segment we could talk about is Mitsubishi. Like, how are you seeing the path towards, taking this from opportunity to realizing some revenue here? Which are the projects you think you will be able to execute on, let's say, the next 24, 36 months, 2, 3 years, long time period?
So again, without being too specific here, I think we've presented material in the past that shows the different areas of adjacency that we have with Mitsubishi explored. And I think that the most practical, the first opportunity is a part of their business which has a very significant market position, and that's factory automation. It makes a lot of sense that vision enablement of factory automation technology and robotics are the areas that have very real application, and probably within the time frame that you just outlined, we would expect to get from proof of concept, which is the kind of stuff we're working on now, through to a commercial offer. So
Okay.
that's probably the key area of focus for us right now. But there are several others. We're just looking at prioritization, and we have a kind of stated focus on the robotic environment also, and we think our sort of mantra around safety AI and looking at the safety aspect through our vision capabilities, in particular leveraging some of the next wave of platform improvement using 3D and perception mapping. We think that creates a very unique opportunity for us to move into those spaces. So
Okay.
bit of water to go under the bridge, but that's what we're doing. They're the focus areas, and I think our partner is being really supportive and helpful to move forward in a way that doesn't divert too much of our resource at this important time.
Okay, that's great. It looks really, really interesting. We hope to see some developments around that. Will be really
Yeah.
exciting. Then the last part to talk about is the financial side. Especially, you have this big process ongoing right now about the debt refinancing. I know you probably can't say much, but on broad lines, are you satisfied with the response you are seeing from the market?
Yeah, look, you're absolutely right. As we think about capital, the short-term priority is refinancing the convertible note. Our objective is to do that with debt. We have a number of initial letters of interest presenting terms, and they range from parties that want to sort of co-op with others through to parties that want to do the whole deal individually. So we expect to complete in June, hopefully earlier rather than later, but June at some point. Based on the initial written responses that we've received, we're highly confident that we will do that. So that's about as much as I can say at the moment. But I think the takeaway is we've got offers. They're with great parties, and that gives us confidence that one or more of them can be done. And just from a process point of view, we think it's highly realistic that we can conclude that in June.
And the objective, I assume, is no dilution.
Correct. That is
Okay.
absolutely the objective. And at this point in time, I don't see anything that would cause me to think otherwise.
Okay, perfect. No, as you are now cash flow positive, like this question might be too early, but how are you thinking about using that cash flow in the future? Like let's go through 27 calendar year 27. You are generating 20-30 million in cash flow at least. How are you seeing the opportunity to reinvest that cash or give back to shareholders? What's your priority around that?
Yeah, look, I think that's probably too close a time frame to contemplate giving back to shareholders the cash in whatever form that could take. But I think what is very clear, at least in the next year or so, is we've got a very disciplined internal investment process. So we're going to minimize allocation of cash into those areas that are lower return, and maybe exit a few of the programs that we've been hanging on to because we thought the opportunity was good, but perhaps it's a little longer than we thought. And we're going to, rebalance that cash into programs that have a return nearer in. So that's the first thing. Second thing is, as I've said a moment ago, we're going to leverage AI much more aggressively across the entirety of our business. And my objective there is to bring new products, features forward so that we can drive revenue growth faster. So investment in parts of our business that can do that, I think, are priorities. Then the other thing is, in terms of the next couple of years, paying down the debt, I think, to an appropriate level is really, really important. We have no plans to raise equity, so that's off the table. And I think retained profits fund ongoing growth, and hopefully we can, as I said, not just grow the products and businesses that we're in today, but direct resources to create new opportunities, and in particular with our major shareholder, Mitsubishi.
Definitely. Okay. So a little bit, it could be, this last question is a little bit of a follow-up. How would you describe like operational success for Seeing Machines over the next 12 months? Like what will need to happen for you in 12 months to be satisfied with what has Seeing Machines accomplished?
Well, I'd like to see our automotive royalty business continue to grow, and I'm expecting it will for a few different reasons. Obviously, the regulations will reset the baseline for Europe over the course of this next few quarters. We have a strong pipeline of RFQs, so I think that will deliver on top of that organic growth into new markets. I'm expecting that we will have a pretty influential role in regulations in the US as we have in Europe, which I think is really positive. I want to see us get to that consistent level of sales in our current aftermarket product, but also I want to be in market with our sort of new licensing model, if you will, in the next 12 months. In a way that actually makes a difference. Aviation, I'd expect recovery at least to a decent level over the next 12 months. All of those factors will contribute to cash generation and give us optionality on a debt repayment, further investment, further product development. But I'm, being in a cash flow positive position and continuing to grow. I mean, if we grow at the rate that we're expecting, with the margins that we're expecting, 12 months from now, that ought to be, completely reset in terms of valuation metrics.
Yeah.
I'm imagining. So markets are markets, and we'll see. but fundamentally, we want to set up a set of performance criteria that can cause us to be re-rated.
Okay. Yeah, that's a great answer. I mean, thanks, Paul. I think we've touched on practically everything on Seeing Machines. And anything you think we've missed?
Not for now. I think you've done a great job, and I really appreciate the time. And they were very, very good questions. So,
thanks,
Hugo. Thank you very much.
Thank you very much, Paul.